$200,000? Yeah, 200. Yeah? Expected credit losses. This is what you expect to occur. So you would determine the loss on an expected credit loss basis. Finally, can you just have a very quick look at the next page, page 157, and FANG. F-A-N-G, FANG. Sorry, not page 300. What did I say? Page 157.
157.
Sorry. Sorry, page 157. Oh my God, I could write so much. It's all just waffle, really. I think in the exam I would need to be tailored by how many marks there were available, because in an exam scenario you really only want to make 1 mark per relevant point. So if there were 2 or 3 marks, I'd keep it fairly tight. If there were 5 or 6 marks, I'd let everything rip. FANG is an entity that holds financial assets until maturity. Shares don't mature. This must be debt. If you're going to hold it to maturity, then it's amortized cost unless you've made the fair value option. We've been invested in bonds issued by Changi. They've correctly classified and accounted for these bonds at amortized cost. When we bought it, the credit risk was low because Changi has a strong capacity to pay its debts because Changi generates cash. It's now perceived that adverse changes in the economic environment could have a detrimental effect. At the reporting date, it has emerged that sales are down. The person we lent money to is not making as many sales as it used to. And other external, Moody's, are reviewing the credit rating. In the market, general bond prices are flat, unchanged, because the market rate of interest is basically the same. But the market price of Changi's bonds has fallen sharply. Now the reason that the bond of Changi would fall sharply, but the rest of the market remain the same, is presumably it's a specific credit risk associated with Changi, because their sales are down and rumours are swirling around that the company may or may not be able to pay its debts. Now we haven't got a load of numbers here, but the first thing that we could talk about here, if we were looking at a long answer, is that it is an amortized cost. Yeah, so the cash flow test must have been met, that the the initial recognition, yeah, would be at the fair value plus the transaction costs, something like that. Yeah, is fair value plus the transaction costs. What you would have to be doing is making a 12 months of expected credit. Yeah, you would make a 12 months expected credit loss on initial recognition. So at the year end, there is evidence in the form of falling revenue, in the evidence of falling bond prices, that there is a significant increase in credit risk. That there is a significant increase in credit risk. And therefore at the year end, you would do a lifetime of expected credit losses. So, a financial asset at amortized cost would have to have met the cash flow test. A financial asset at amortized cost is initially recognized at fair value plus the transaction costs. A financial asset at amortized cost is required to make a 12-month expected credit loss where you take into account past, present and future information, which makes it therefore a subjective process. At the year end, there is evidence that sales are falling. At the year end, there is evidence that the bond prices are falling. At the year end, there is evidence of a significant increase in the credit risk. As a result, you would therefore make a lifetime of expected credit losses. There would be a bigger write-down required. I'm pausing for a second. I'm talking about impairment losses on financial assets. And I have just finished talking about impairment losses on financial assets. Yeah? Could you, honestly, in your exam, that, this type of question is often examined for, 3, 4, 5 marks. And so, some people, don't know where to start and struggle, but you've got to write. You've got to flow, you've got to say something. And in this particular question, you've got the benefit of the fact that I've been talking about expected credit losses, and you've got the benefit of the fact that it says question found impairment review. So it's rather in your face that it's about it. But if you're looking in the exam and you've bought some investments and they're amortized cost assets, one of the things you should throw in is this business about impairment reviews on an expected credit loss basis. And if there's any suggestion that the credit risk is going up, if there's any suggestion that the money you are owed is not coming back to you, then you should be looking to make a lifetime of expected credit losses, a much bigger provision for bad debts. Yeah, initial recognition of an amortized cost asset is at fair value plus. Yeah? Fair value plus transaction costs. Yeah? Yeah? Fair value plus transaction costs. Right, let's finish off financial assets and then check what the time is, but let's just first of all quickly finish off financial assets.
Can the company decide they want to debit the expected loss is credit card?
Yes, when you're charging an expense, you're debiting the P&L. Yeah.
Can the company decide that they want to charge the debit expenses on this expected credit loss? Can the company this year I don't want to get, and I don't want to put any expected credit plus the debit side at that year. Or is it compulsory?
Compulsory. It's compulsory. Yeah. I mean, if they want to fiddle it, they just say, well, we think the risk is very low. We think it's 1/4% or 1/5 of 1%. So they would use their judgment to make it as low as possible, but they would have to go through the process and they would have to then justify their figures to the auditors. But they would have to do it.
One question regarding this. We just came to this conclusion that lifetime needs to be implemented. But what if next year, I mean, we just get it on a piecemeal information. There's nothing quite substantial that we need to do with lifetime. So next year, the profits are good.
Sorry, start again. So we have a requirement to do a 12-month basis. Yeah, so we have a requirement every year to form a judgment as to what our expected credit losses are going to be in the next 12 months. Even if we are borrowing money from the British government, even if we're borrowing money from a AAA credit rating, we must do 12 months. Now, if we perceive that there is a significant increase in the credit risk, we then jump to a lifetime. So we would say, over the 10 years, what do we think the chances of that defaulting if it's a 10-year bond, and if over the 10 years they defaulted, what do we think the losses we are likely to face? What's the range of outcomes that there could be?
But why are we basing 1 year's performance and getting on to 10 years? Because next year, what if they have an increase in profits like 20%? So our previous judgment won't apply in that sense.
That's always the case. It's always the case that you're making a judgment.
So
useful lives of an asset. Yeah, I judge today that my asset's going to last 8 years. So I base my depreciation on 8 years. Now next year, I will perhaps reappraise what I think the useful life of the asset is, and I may change my mind. I may leave it at 8, or I may change my mind to 10. So when you're looking at the credit worthiness of an investment, when you're looking at the credit risk of an investment, it's not a decision that you make and then you never change your mind. But by the very nature of provisions for that debt, you're updating your information every year. Yeah? Right, let's just deal with a couple of terminologies just to make sure you're comfortable with it. Reclassification of financial assets. Reclassification of financial assets. So you've got your 3 categories: amortized cost, fair value through P&L, fair value through OCI. Is it possible to reclassify them? The answer to that question is yes, but it is unusual. It is an unusual thing. And you can only do so if the business model changes. Only if the business model changes. So if you've got a business which has always had a business model of never selling, always holding it to maturity, but then decides to change their business model to trading them, that will be a change in the business model. So only if the business model changes. And the accounting would be on a prospective basis. The accounting would be on a prospective basis. Going forward basis. You wouldn't do a prior period adjustment. Sometimes what happens in the exam is there's a phrase used that you've never heard before. Yeah, I come across this, that, you say, I didn't know what it meant. I've never heard the phrase. I didn't know what the term meant. And in an exam, sometimes you can work out the context of it, but if it's a technical term, you might be lost. So here goes. Let me expose you to the language. Treasury shares. Treasury shares. Ooh, very treasure. Treasury shares. Have you come across that before?
No.
Sort of thing you might do in P4, maybe F9. Not a treasury bill, no, treasury shares. Correct. Some people have come across it before, but only a few. This is why I'm dealing with it, flushing it out. I've never seen this in the exam. This takes 2 minutes, and then if you do see it in the exam, you know what it's on about, and most other people won't. But you will. Treasury shares is when you buy your own shares. So as a company, you engage in a share buyback. Yeah, you buy your own shares. Credit cash, yeah, debit, treasury shares. Yeah, so treasury shares is the purchase of own shares. This is the purchase of our own shares. How weird is that? Because you're buying your own shares. How weird is that? Yeah. Because that's incest. It's just wrong. It doesn't feel. It's weird. Just weird. So you've credited cash, debited treasury shares. You can't show it as an asset. It doesn't meet the definition of a financial asset. What you've done is you've reduced your own equity. Because if you've got 100 shares out there and you've bought one of them, then effectively there's only 99 shares. So you would show this as a deduction from equity. It would be presented as a reduction of, so present as a deduction from equity. It would be presented as a deduction from equity. And there would be no gain or no loss ever arising. So you don't get involved in making a profit from your own shares. Finally, derecognition. You derecognize a liability when it's extinguished. You derecognize a liability when it's settled. You derecognize a liability when you pay the liability and you no longer have an obligation. You derecognize a financial asset when you no longer have future economic benefits, when you no longer have the rights to cash flows. Yeah, where the derecognition is where the rights to cash flows expire. Where the rights to cash flows expire. Or substantially all the risks and rewards. Or substantially all the risks and rewards pass. So this would be when you would derecognize a financial asset. This would be when you would derecognize a financial asset. We are going to take a break tonight.
How do we do the accounting for this?
If you derecognize the financial asset, then you're crediting the asset. So you've received the money. It's so you've sold it. So you are derecognizing it. If the asset simply ceases to exist and you haven't got any money for it, then you're just writing it off.